Hey everybody, it's Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania with the first of the month update for September. The best thing about September, as you can see from my shirt, it's the start of college football season. And obviously as a Minnesota Golden Gopher, we are pumped this season. But we also have professional football following. So thank God for fall because football is back. So what am I going to talk about in September? There has been a lot happening in the last couple of weeks. One of the things that happened about a week and a half ago was the Fed meeting in Jackson Hole, Wyoming. Now, a little history there. A lot of times when the Fed governors used to get together, it was hard to get them all together. And one of the Fed governors that particularly didn't like to do meetings, the only way that they could get him to come and do a meeting was to have it at a place that had trout fishing, which turned out to be Jackson Hole. So guess what? Every summer they reconvene at Jackson Hole and talk about what's going on with interest rates and the economy. And what happened a couple of weeks ago after the Jackson Hole meeting is that Chairman Powell came out and he used the word in his speech that there might have to be some pain in the labor markets as they continue to raise interest rates. Well, what happened with that? Here's my S&P 500 chart, and you can see that we actually had a really nice rally, almost 17% from the low in June through about the third week in August. And if you see where my black arrow is pointing, ever since Chairman Powell's speech, the market has sold off, the S&P 500 has sold off and given back about half the gains from the rally it made off the lows in June. Now, we believe that this is a pullback within an uptrend, not just a bear market rally. A lot of our risk indicators dramatically improved in the months of July and August. They kind of topped out. The short-term risk indicators got a little bit overbought. We were expecting some kind of 3 to 5 to 7% pullback, and we've gotten that at this particular point in time. So let's talk about the bond market. Our view on the bond market is, again, Chairman Powell came out and said that the Fed is going to continue to raise interest rates. We knew this all along. The bond market kind of didn't believe him. And sure enough, interest rates have turned around in the month of August, and they've gone back up over 3% to almost 3.25%. Again, we think this is offering value on the long end of the curve. But the good news is on the short end of the curve, you are finally getting paid to invest again in a bank CD. So the last couple of weeks, we've seen bank CD rates, which you can get. Our custodian is TD Ameritrade, and they use about 200 different banks. Bank CD rates are about 2.85 to almost 3% for a 6-month bank CD. So the good news with interest rates going up, you do have some alternatives for your short-term safe cash, which you might want to take advantage of. But we do believe that longer term, there's a lot of value with the 10-year Treasury back over 3.25%. There's a lot of value in tax-free bonds and intermediate corporate bonds as well. Now, the other thing that's going on is everybody's concerned about inflation. And that's one of the reasons why the Fed has been so aggressive raising the Fed funds or short-term interest rates. That's the only part of the yield curve that they control. But we've seen inflation and a lot of the components of inflation drop rather dramatically. And here's a chart of the oil market. You can see after it peaked here in end of June, basically we've had a free fall in oil. Now, there was a little bit of a rally the last week or so, but in the last couple of days, oil's come back down. If you look over on the left-hand side of my screen here, you can see that I've circled where oil began the year at, $75 a barrel. We're currently trading right around $85 a barrel. It would not surprise me to see oil back under $80 or $75 a barrel before the end of the year. Now, one of the positive things about that is that's going to also relieve some of the inflation pressure out there as gasoline prices drop. So we want everybody to keep focused on what's happening in the energy markets. The energy markets were a big driver on the upside for inflation. We think that they're going to be a big driver to show that inflation is being reduced, and therefore the Fed may not have to as aggressively raise interest rates as everybody thinks. So what happens to the rest of the market? Small mid-cap stocks. Again, we use a lot of relative strength measures in our practice. And for the last year, small mid-cap stocks have shown the greatest relative strength. Now, I call this the horse race indicator. And what's happening right now is small mid-cap stocks will lead on the upside. And so you can see that that same rally that we've had from the bottom in June through the third week in August, which the S&P 500 was up about 17%. You can see that small mid-cap stocks, as measured by the Russell 2000, was up 23%. So that shows you that when the market starts to really turn around and take off, small mid-cap stocks are leading the charge. So what does this all mean to you for September? We had a strong stock market rally in July and August. It was cut short again by hawkish Fed comments. Gee, that seems to be a repetition of the same thing that happened in the March and April timeframe when Jerome Powell came out and made some hawkish comments at that point in time too. But again, hawkish comments cut the rally short. We were overbought because it was a rather large rally off the lows. The bond markets have seen yields rise up. As investors realize that the Fed's going to continue to raise short-term rates. We think that they go at least 50 to 75 basis points in September, maybe another 50 sometime in October. They take November off, and maybe 25 in December to get to the Fed funds rate of right around 3.75% to 4%. However, what that does is on the short term, it makes short-term bond investments attractive, but also don't forget about long-term bonds as well. They're showing a good value at these levels. Our risk indicators are at midfield. And again, the thing that we want to point out is that the market previously in June was pricing in a moderate to severe recession. We've gotten a couple of monthly jobs reports. And by the time you see this video, we'll have gotten one for August. The July jobs report was huge. August is expected to be as good as well. Well, it's very, very difficult to have a recession when you have positive job reports where people are entering the workforce and employers are looking for people to add to their company payroll. So it's very difficult to have a severe recession. And we think the stock market really overreacted in June, pricing in a moderate to severe recession. We think between now and the end of the year, people will realize that, hey, companies can live with higher interest rates, lower energy prices, and that the market's offering attractive values. The equity markets are offering attractive values in certain spaces. Specifically, we believe in a small mid-cap area. So that's our first of the month update. We hope you enjoyed it. We'll be back next week with the Englebert Angle on a different topic. Again, if you want to be up to date on what we're doing, you can always download my app by texting Chris E, CHRISE to 36260. Download my app. These videos are posted on my app, so you can watch them at your leisure and enjoy college and professional football season this year. Way to go, Minnesota Gophers and Philadelphia Eagles. Talk to you soon.